Good morning and welcome to Allianz third quarter results web audio conference. The conference is scheduled to last up to 90 minutes today. As usual, our CFO Giulio Terzariol will guide you through the quarterly results and will then take your questions. I hereby hand over to Giulio, please.
Thank you, Holger, and good morning to everybody. And I'm pleased to present, as always, the results for the third quarter of Allianz. But before we go into the third quarter results, as usual, we give also a short update on the picture for the 9 months. Overall, we had a very strong set of results for the 9 months with an operating profit of over 10 billion. This is driven particularly by property casualty, but I will say that all segments have contributed fairly to the operating profit, subjectly to the current market condition. When we look at the property casualty segment, we have a combined ratio which is basically stable over the last year level, but we are benefiting here from higher premium growth, and also we have a much better investment results. In the life segment, we can see that the new business margin is significantly improved compared to the one that we had last year, and also it's a good new business margin at a very good level. We have a lower production. That's not unusual in an environment like this, but as you see, the value of new business is higher compared to the level of new business value that we had last year. And finally, in asset management, yes, we have outflows. That's not unexpected in an environment like this. But when you look at the operating profit, we have basically 2.4 billion of operating profit, which is very stable compared to the level that we had last year. So that's a strong positive sign. So all in all, very good results for the 9 months. And as you know, we have revised our expectation for 2022, so now we expect to end up in the upper half of the range of our outlook. With that, I'd like to move to page 5, where we had a snapshot for the third quarter results. The narrative is more or less the same that of the narrative for the 9 months view, with very strong results in property casualty and with a nice resilience in life, health and asset management. On top, you see the net income is very strong at 2.5 billion, and that's driven by the operating profit development, but also we had some realized gains below the line. So a strong picture for the third quarter. I was told this is the highest operating profit for a third quarter, and as you see, is also improved over 7% compared to last year. Now we come to the solvency ratio. The solvency ratio, slide 7, is at 199%, which is a good and comfortable level. This is before the deduction for the buyback that we have announced last night. So after the deduction, the buyback, we are still at a very good and comfortable level of 197%. The sensitivity have improved compared to what we had in Q2, and I'm referring here to the sensitivity to the equity market. In Q2, we had a sensitivity of minus 20% for a drop of the equity market of 30%, and now, as you see, we are at minus 17%, so there is an improvement, which is also a function of the risking action that we have been taking. So a stable level and also reduced sensitivity to the equity market for our solvency ratio, and clearly we continue to deploy capital in an efficient way. If we move now to page 9, this is the evolution of the Solvency II ratio for the quarter. And as you see, we continue to generate capital on an organic basis. On a pre-tax and pre-dividend basis, we have a 7 percentage point of capital generation. If you adjust for taxes and dividend, that's a good 2 percentage point of capital generation that we should be able to create on a quarterly basis. For the quarter, you see that there is a negative impact coming from the market movement. This has to do with rate volatility, with a drop in the equity market in Q3, and also with some twisting of the credit spread. This kind of movement clearly are volatile, so sometimes they can be positive, sometimes they can be negative. What really counts at the end of the day is the ability to generate capital on an ongoing basis. And so from that point of view, we are starting from a good level of Solvency II, and we can always rely as we move forward on a steady capital generation from the underlying performance. So that's on the solvency ratio evolution. Now we can go into the segments. Page 11, we start as always with the property casualty segment. You can see that we had a very nice growth in property casualty of 9% if you adjust the numbers for a fix and for consolidation. If you take the total growth, is a total growth of 14%. So a very strong number. If we look at the internal growth of about 9%, the driver there is especially price. So 80% of that number is explained by price changes, which is a clear indication that we are taking action clearly to offset the inflation that we might see coming in our claims. What is also good in this picture is that basically all OEs, or almost all OEs are contributing to the growth of the segment. So you can see that across the board we are taking action that are leading to this growth in premium. So that's a very good picture, also because it's not just coming from a few entities, but because it's coming from basically almost all entities. If we move to page 13 on the operating profit development for the quarter, you can see there is a nice improvement of over 30% compared to the level of last year, or about 400 million. Or over 400 million expressed in absolute euro terms. And the improvement is coming both from underwriting and also from investment income. If we focus first on the underwriting results improvement, there are basically two drivers. One is the improvement in or the increase in premium that we saw before, and the other reason for the improvement in the operating profit or underwriting results is due to the combined ratio, which is lower compared to what we had last year. If you look then at the components of the combined ratio, we see that we are benefiting from lower net cat compared to the third quarter 2021, and also we have a higher runoff. So from that point of view, clearly this has helped the combined ratio, but I can also tell you that we are very prudent on the way we choose the loss pick for the accident year 2022, where we are setting specific provision for inflation. So the bottom line here is that the quality of the 94% combined ratio is, in my opinion, very good. And that's the main message that I want to bring across. So 94, very solid combined ratio with increasing level of premium. When you look at the picture by companies at page 15, you can see that a lot of our entities are providing very good combined ratio. This is true for Germany, France, Australia, Eastern Europe, Italy, Switzerland, GCNS, partners considering their business model. 96.8 is a good combined ratio, and also Allianz Trade. So you can see basically almost all our entities are providing very good results. There are a couple of exceptions, like Latin America, which is driven by Brazil. We see stabilization there, and also in the United Kingdom. Also, the combined ratio is higher compared to what we were expecting. This is driven by some one-off, and also is driven by some inflation impact which is coming through. What is positive, both in the case of Latin America and UK, this is not a idiosyncratic situation for our entities. This is something that we see in the broader market, which is also indicating that most likely we're going to see a nice improvement moving forward, because clearly the marketplace will have to react. Bottom line anyway, the majority of the companies is providing really healthy combined ratio, and this is, in my opinion, very strong picture. And with that, I would move now to page 17, where we see that the investment income is also significantly higher compared to what we had last year. We are speaking of an increase in investment income of about 36%. And when you look at the current yields, you can see that that number is now more than 10 basis points better compared to what we had last year. And what is really eye-catching is the development of the economic reinvestment yield, which is now at 3.5% compared to 1.3% 1 year ago. This means that we are going to continue to see strong investments result as we move forward. So this is going to be definitely a driver of operating profits improvement compared to what we had in prior year. So overall, bottom line, very strong results in P&C with growth in premium, a stable combined ratio, increase in investment income. The quarterly operating profit was 1.7, which is well ahead of the outlook of 1.5 billion per quarter. And we also believe that this performance can be repeated in the future. So this is a strong underlying performance, which is not driven by one-off. And with that, I'd like to come to the life segment, where we have also a positive message. And when you look at the new business margin, the new business margin is for the quarter at the level of 4%. That's really an excellent level. And those segments are contributing to the growth, to the increase in new business margin. When you look at the present value of new business production, this is down compared to last year. Here we should do some adjustment because last year we had a big contract, a corporate contract coming from Allianz, plus there are some technical things that should be adjusted for. So if you do that, the present value of new business premium reduction would be more like minus 10% instead of minus 30%. And the fact that it's down is not surprising in an environment like that. Clearly we are investors, policyholders are going to be a little bit more conservative. So from that point of view, we see a little bit less sale of unit-linked business, and also single premium. It's down compared to the last year level. This said, our focus has always been on margin rather than pure growth. So from that point of view, this is a picture we are very comfortable with, and we really like the 4% of new business margin, which is also something which is going straight into our Solvency II calculation. So this is a number which is relevant because it's contributing to the organic capital generation of our Solvency II calculation. And with that, if we move to page 21, the operating profit is about 200 million lower compared to the level of 2021. Here we need to also remember that in 2021 the capital markets were very favorable. So from that point of view, last year we had rather the positive volatility coming through the numbers, where this time we have rather the negative volatility coming through the numbers. And as you see, when you look at one of the major drivers for the drop is due to the guaranteed savings in the annuity business, where you see 200 million less of operating profit, and half of that 200 million is due to the VA business in the US that we know is particularly volatile. So considering the market condition, I view the swings as totally normal, and I would say that making over 1 billion of operating profit in this kind of environment is a sign of strong resilience. And with that, at page 23, on the value of new business margin, first of all, you see, similarly to what we saw for the combined ratio, that the new business margin is basically improving across the board. When you look at the value of new business, it's down by about 17%, but this is due to this large contract. So when you adjust for the large contract of last year, in reality the value of new business is up 2%, so again, a good underlying development. And when you look then at the operating profit, as you can see here, we have once the drop because of the VA business in the USA, and also the operating profit of Allianz Leben in this kind of environment has been a little bit softer because of the lower harvesting results. But overall, a good set of operating profit. And this leads me to page 25. That's indeed a very positive picture. Yes, the investment margin is down by 4 basis points, and that's because of the harvesting, which has been negative this quarter compared to usually the expectation of a positive net harvesting. But what is really important in this slide is the differential between the current yield and the minimum guarantee. If you look at that in Q3 2021, that differential was 51 basis points, and now we are speaking of 57 basis points. This is really the underlying performance, because the harvesting can be clearly volatile up and down. What counts over time is that this differential is going to be healthy, and as you can see, is going up. I also look at the annualized number. In 2020, the differential between current yield and guarantee was 1.8%. In 2021 was 2%, and by the end of this year we should be at 2.2, 2.3. So a swing of 50 basis points within 2 years on a 500 billion reserves is about 2.5 billion of profit, if you want, which we are going to share with the policyholder, obviously. But it gives you the idea of the extra cushion that has been built up in the last 2 years by the work that we did on our products. So overall, positive development in the life segment with a new business margin of 4%, a very healthy development of the differential between current yield and guarantee. So the underlines are good, and clearly in this quarter we are paying some price in operating profit because of the volatility, but still we have achieved an operating profit which is in excess of 1 billion. And with that, we can go now to the asset management segments. Overall, the assets under management have been relatively stable compared to the level of June. You see a drop of 3% here, but this is basically explained by the transfer of the AGI US assets to Voya. If you adjust for that, in reality the drop in assets under management would be only 1%. And when you look then specifically at PIMCO, you can even see that there is a flat development of the assets under management. So overall, despite all the volatility in the capital markets, the asset basis has been relatively resilient. And when we look then specifically at page 29 to the development of the third-party assets under management, you see that we had about 20 billion of outflows. Thereof, 3 quarters are coming from PIMCO, 1 quarter is coming from AGI. In this kind of environment, it's not unexpected to see this kind of development. I would even say it's relatively moderate if you think that PIMCO has basically 1.4 billion of assets under management, of assets under management for third party. 50 billion is really not a big amount. And then when you look at the delta or the netting of market and dividend and the fixed and others, you see there is a 24 billion drop, and this is basically all explained by the transfer of the AGI US assets to Voya. And with that, if we move to page 31, on the revenue are resilient, indeed are basically flat over the level of last year. Clearly we are benefiting here from the appreciation of the US dollar, but at the end of the day, the US dollar is also an economic parameter, not different from the equity market development or from the interest rate swing. So from that point of view, this also counts in our math. So basically flat revenue. And what is very positive is the development of the third-party assets under management margin, which is slightly up compared to what we had 1 year ago. And the point is, yes, we have outflows, but there is a little bit of a tendency to see outflows in mandate with lower fees. So from that point of view, there is also something to consider. It makes a difference if you lose on more assets on higher fee mandate as opposed to lose assets on lower fee mandate. So that's also something that is helping the resilience of our results. And when you go to page 33, you can see that the drop in operating profit was 10%. If you adjust for the performance fees, is about 8%. Here we should really keep in mind that the third quarter 2021 was almost at the peak of the capital market. So that's we are going basically from the peak to, I don't know whether it's the bottom, but definitely to a situation which is much different compared to what we had 1 year ago. And when you look at the performance of PIMCO, is more or less stable compared to what we had 1 year ago. And in the case of AGI, you can see a drop. The performance in 2021 was extremely high. I would say that with 178 million of operating profit in the third quarter 2022, that's a very good result for AGI. If you annualize that number, you will get to a very strong operating profit. So overall, I would say in asset management, clearly the market conditions are a little bit challenging, but at the end of the day, we have 800 million of operating profit. Our outlook divided by 4 is 850, and this assumes the performance fees are spread equally over the year, which is not the case. In reality, we know that we get more performance fees towards the end of the year. So basically, a operating profit of 800 million is consistent with our outlook, and now we're going to see clearly what happens in fourth quarter based on the market volatility and also how much performance fees we are going to get. But these numbers are trailing very closely our outlook that we gave you at the beginning of the year. Corporate, it's significantly improved, page 35, compared to last year, and this is driven by higher investment income. The driver of higher investment income, interest rate level, which is higher, dividend, and also we have some inflation-linked bonds in our corporate portfolio. So these all explain the majority of the nice improvement that we see in our corporate segment. And now we come to page 37. On the below-the-line items, as you see, we had about 650 million of realized gains. These realized gains are driven by the transaction of the disposal of AGI US to Voya, and also we sold a participation, minority stake in a bank in Croatia. On the other side, impairment are a little bit more elevated in this kind of market condition, but the net position, when you net the two items together, is positive compared to last year. So this, together with the increase in operating profit, leads to a shareholder net income which is 17% higher compared to what we had last year. So with 2.5 billion of shareholder net income, that's a very strong performance for the quarter. And with that, I come to the end of my presentation. So very strong set of results, strong underlying. As you know, we have revised our expectation for the remainder of the year that we are going to end up in the upper half of the range. We have 2 billion of buyback for 2022. If you add up this to the 4.5 billion of dividend that we paid in May, that's 6.5 billion of remittances. So definitely a strong set of results. And with that, I'd like to thank, as always, our employees for the excellent job that they do every day. So with that, I would open up to questions.
Thank you, Giulio, for your explanations, and indeed a great set of results. Before we go into the Q&A, let me remind you, if you want to ask a question and you join via web audio call, please press talk request. If your question has already been answered, press 6 to withdraw. If you join via telephone, please press 5 to raise your hand and to signal that you want to ask a question. So, I give you a few seconds time, and then we start with the Q&A. Our first question today comes from Herbert Fromme, and your line should be open.
Yeah, thank you very much. I've got 3 questions. One is, what effect does Structured Alpha have on your 2022 results? Your share price for the year so far is minus 7.9, and that's worse than major rivals. Munich Re is +8, Zurich +12, AXA +0.3. Only Generali is in minus. Why is that? Why do shareholders not trust you? And then I would like to know, you more or less shut down Sincere, your IT subsidiary. What kind of write-down was needed there? And perhaps you can enlighten us on the full software problem, ABS. What does this cost Allianz, and what write-downs can you expect on that?
No, thank you for your question. Structured Alpha, in Q3, there was basically no impact on our numbers because of Structured Alpha. The only part would be clearly, you can always consider the gain that we posted. That could be a consequence of Structured Alpha, and also now we are running, the gain of about 300 million. That would be a consequence clearly of the Structured Alpha situation. And also, basically in Q3, AGI is being running with a new setup. So from that point of view, we would have had maybe 20 million more operating profit in the case we had kept the asset that we disposed to Voya. But there is no basically meaningful impact on the operating profit, I would say, of the group for Q3 due to Structured Alpha. So regarding your question about the development of the Allianz share price compared to the competition, but first of all, we need to say that clearly the Structured Alpha situation had some impact on our share price, but also, as you know, it's always difficult when you compare point to point, because if you take a different reference time, then you get to totally different results. So usually I don't take a very short period, I take longer period. And so I'm sure that if you look for a period with outperformance of Allianz, it's not going to be so difficult to find that. So it's very important that, you consider different time reference, and then you can get to a better judgment of whether there is a underperformance or not. I can tell you that from 2015 to the August 2021, the outperformance of Allianz compared to the index, the insurance index, was about 50% percentage point, if I'm not wrong. So it's all a matter of reference point. And then your question about Sincere, and then you had the question about ABS. Sincere is a venture that we started basically in 2018. And, sometimes things are working better than others, so we decided that eventually this was not an initiative that could be successful, so we decided basically to stop that initiative. I think that's totally fine that a company, a group of our size, is going to try different things. As I said, sometimes things are working, sometimes things are not working, but I don't see anything bad in that. And regarding the ABS software, there is no ABS software is doing what it's supposed to do. We are implementing the ABS software is already implemented in most companies. As you know, we are driving the homogenization of our business model, of our IT infrastructure. We already did that. We tried to harmonize the IT architecture, and there is no no kind of concern about any depreciation of the ABS software at all.
And how much did Sincere cost you?
Sorry?
How much did Sincere cost you?
But look, I can tell you for this year or for this quarter, I think the impact of Sincere was slightly about 10 million.
So the whole investment, but was written off or written down in some way, wasn't it?
No, there's definitely an investment where we have at the end of the day a loss. There is no doubt, but that's part of doing business, trying things. And some things are working, some other things are not working. And when you look at our operating profit let's say right now we have record operating profit. Basically, we are set to have record operating profit. Last year we had record operating profit, so you need always to put things in perspective. But that's the reality. That as we try a lot of things, some things is successful, something might not be successful, but the bottom line is that in 2021 we posted record operating profit, and based on what we are seeing right now, we think we are going to have again record operating profit in 2022, and we just had, based on what I was told, the best operating profit of the third quarter. And then clearly we can always start talking about all the things which are going well, and we can also talk about the things which are not going as well. Okay, thank you.
Thank you. Then the next question comes from Michael Fleming from Börsenzeitung. Michael, the line is open.
Hello, Mr. Terzariol and Mr. Klotz. I have two questions, please. One to the outlook, one other to the harvesting. To the outlook, you have quite a way to go to reach the middle point of the new target range, 13.9 billion euro. What are the factors to be so optimistic in the last quarter in a quite recessionary scenario? The second one, you said you made a lot of harvesting with substantial losses and impairments. Why did you decide to do so? Is it because of the market environment or with a view on the solvency ratio? Thank you.
So on the harvesting, you mean there was negative harvesting in life? This is coming basically just from the IFRS accounting, where when you have the value of the equity holding that you have goes either below 20% within a time frame of 9 months, or stays below the book value goes either below 20% compared to the book value, or stays below the book value for more than 9 months. You need to do a depreciation. So that's basically what the IFRS accounting says, and this has been driving the majority of the impairment. This was not an active selling equity and realized impairment. Also, in our case, because of the Solvency II, we are keeping some derivative position, which is clearly providing economic hedge. But from an accounting point of view, you get a mismatch. So there is also a little bit of accounting volatility there. So no specific decisions, more the consequence of how accounting is applied. And as you can imagine, capital market creates volatility up and down, and to a certain view, accounting is going to reflect the volatility, and sometimes accounting can even exacerbate that volatility due to accounting mismatches. But nothing really where we should be concerned about fundamental impairment. The only exception would have been the impairment at the beginning of the year related to Russia. That's the only thing which is really systematic as opposed to pure volatility. On the other question, which was about the outlook, that's the way we see the situation. In property casualty, we had a 1.7 billion operating profit, and based on what we see right now, this is something that is definitely repeatable. As always, we don't know what Nat Cat might be doing, but you should keep in mind we have also an aggregate that could give us a protection in the case the Nat Cat activity is very pronounced in the course of the next 6 weeks. And we know that we have a strong investment income, And also we see that from an underlying combined ratio, we have a good view what the underlying should be. So fundamentally, clearly, I'm not saying that we're going to have 1.7 billion of operating profit in P&C, but this is something that could be a reasonable expectation at this point in time, and then we will see. So that's number one. On the life side, I would say the following. First of all, part of the reduction operating profit compared to our expectation is coming from the VA business in the U.S. Technically speaking, this is driven by higher hedging cost. There is a point where the markets are going down, the hedging costs are getting lower. It's a technical issue because the guarantees are, once they are more in the money, there is less need to hedge, or there is less, I would say, doing the hedge is less costly. That's basically a consequence of just how the liability are working. Also, on the same time, we think that we're going to have some positive unlocking coming from Allianz Life. So from that point of view, and also I would say regarding other companies, the majority of the impairment have come through basically in Q1, Q2. So fundamentally, we expect to see better results in life in the fourth quarter. And then in the case of asset management, yes, the markets are tough. And from that point of view, also the assets under management that we have right now are a little bit lower compared to what we had on average in Q3. But on the other side, in Q4, we also get performance fees. And now there is always clearly some uncertainty around the performance fees, but we still expect to get more performance fees compared to what we had in Q3. So that's also an element to consider. And then, as you saw, throughout the year, our corporate segment has been much better compared to the outlook that we had. So we expect also in fourth quarter the corporate segment to be better compared to our outlook. So basically, I would say we should expect similar performance in property casualty, and we would expect to see better performance in asset management life and in asset management life in Q4.
Okay, great. Thank you very much.
Welcome.
Thank you, Michael. Our next caller is Sam Casey from Insurance Insider. Sam, your line is open.
Okay, can you hear me okay?
Yeah.
Could you talk about what impact you think Hurricane Ian might have on the pricing conditions in the commercial market, both in terms of the lines of business you operate in, but also in terms of reinsurance buying too?
Okay, no, thank you for the question. So first of all, I want to say that for us, Hurricane Ian was not a big event. At the end of the day, we have less than 100 million of impact coming from Hurricane Ian. And then to come into your specific question, we know that on the insurance markets right now, the market is hard. So we definitely expect to see an increase in premium that we need to pay to our insurance companies. And the Hurricane Ian can be just, again, a confirmation of this trend. But I don't think it's going to make a huge difference because we already, based on the conversation we were having before Hurricane Ian, we know that price is going up. So clearly, this can just strengthen maybe or confirm that trend, but I don't think it's going to be a big game changer unless you are completely exposed to that area. That's a different story. For us, we are not really affected by Hurricane Ian, so I don't think it's going to have an impact at all. For our conversation with the insurance companies, in some cases, it might have an impact. Overall, I would say we are right now in a market where we need to expect that we are going to pay a higher reinsurance premium for 2023. And that's part, by the way, of the way we're also setting our pricing. So from that point of view, I don't think we're going to have any surprise. We have a very clear view of what the condition might be for 2023 at this point in time, plus minus, or as always some range. But fundamentally, I think we know what we should expect.
Great, thank you.
Welcome.
Our next question comes from Ben Dyson from S&P Global Market Intelligence. Ben, your line is open. Hello, Ben. Your line is open.
Hello, can you hear me okay?
Yes, we can.
Okay, great stuff. Sorry about that. Yeah, I just really wanted to ask about the impacts of inflation, really. I mean, I've seen a couple of impacts in the pricing and the results this time around, but I was just wondering if there were any concerns about reserving with relation to inflation, and whether that, particularly for long tail line, you were going to have to increase reserves.
Yes. So, but we don't have major concern in the sense of, first of all, especially for the time being on the long tail line, we don't see reality inflation coming through. Clearly, this can change over time, but keep in mind that for that kind of things, we have also inflation-linked bonds on the other side, so there should be potentially an offset. What we do, however, is we are setting specific reserve for inflation in general. This is also for the accident year 2022. So from that point of view, we don't have concern because we are taking anyway action that are already in our reserve, which are already flowing through the numbers. So when you look at our 94 combined ratio for this quarter, you need to consider that we put into this number a sizable, we'll say, reserve for inflation. So from that point of view, we are not just naively thinking that inflation might not have an impact, but this is already included in the numbers. What is also important is, as you see, the premium growth has been substantial. This is premium growth coming from rate changes, so that's clearly a nice offset to the inflation, and I can tell you that rate changes are going to accelerate as we go into Q4 and also into next year. So from that point of view, we are going to get more rate changes and not less changes. And then the third point is we always focus on inflation, but there is a lot of something that we can do on the claims handling too. So it's not like you see inflation, you need to consider this one-to-one as this is going to impact the claim severity. So the combination of we are already taking action in making sure that we build reserve for inflation, the fact that we have rate increases which are substantial, the fact that we are going to have even larger rate increases, and the fact that we are taking also action on the things we can control to mitigate the claim severity, they should position us well to be profitable in this environment. And also keep in mind, just in the quarter, we had about 200 million more, 150 million more investment income, 150 to 200 million more investment income compared to our plan. So there is also a big offset coming from there. I'll give you another example. We were thinking that we're going to achieve the mark of 59 billion of NPE by 2024. We're already there as on now. So this is also clearly, as long as you have a combined ratio which is way below 100, this is also a positive for the operating profit development of the company.
Okay, great. Thanks. So sorry, I have a quick follow-on question from Sam's question about reinsurance. I'm just interested if the price increases that you're expecting on the reinsurance side will prompt any changes to your reinsurance buying strategy, and whether you may have to buy less in certain areas.
So we are doing some refinement to our strategy, but I would say fundamentally we are not changing let's say the program. So we are doing some changes, and if you ask me, sometimes you can get more aggressive on some position, other position can get more conservative. If you ask me, we are getting more conservative on the amount of program that we are going to purchase. So some tweaking up and down, fundamentally a little bit more protection, and we know that we are going to pay a little bit more of a premium. But this, you can put this also as part of managing the inflation.
Okay, thank you very much.
Welcome.
Thank you, Ben. Our next question comes from Alexander Hübner from Reuters. Alexander, your line is open.
Ja, vielen Dank. Thank you very much. I have some detail question. First one on Russia. You had said before that you're expecting the closing of your sale of your Russian business in Q3. Now you're saying it's rather Q4 or even Q1 next year. What's happening here? Can you elaborate a bit on that? The second one is on Voya. As far as I remember, you had said that some more than $100 billion in assets under management are affected by that move. Now I'm seeing that it looks like it's only 42 or something. What has happened here? And the last question is Nord Stream on this incident, this blow up of the pipeline. Are you as an insurer involved in this in any kind as an insurer? Thank you very much.
Okay, no, thank you for the question. So maybe let's start from the last one. Basically, we have almost no exposure to the Nord Stream, so it's completely material. So let's say the answer is no. We have some exposure, but we are speaking of very, very, very small number. And we don't think, by the way, it's going to materialize. But anyway, we're speaking of a very, very, very little number. On the Voya transaction, you need to consider that we have about 61 billion of assets, which are still included in our numbers because we are not managing the assets in the sense of basically the investment management is with Voya, but we are administering the funds, and also especially we are distributing the funds. And the point is that we are not necessarily getting the same amount of profitability that we were getting before. We are still getting a sizable profitability from so that's the reason why in reality you need to take the 42 billion, but then you need to add up about 60 billion to come to the 100 million. And then for Russia, the point is clearly, you need to go through negotiation and approval processes, and so this can take time. If you want to volunteer for the negotiation with the authority, you can do that, but as you can imagine, this can take some time, and we are not controlling the process. But basically, the train has left the station, so at the end of the day, it's just a matter of when we are going to get the approval. But from our standpoint, there is no second thought, so that's basically just going through the process.
Okay, thank you.
Welcome.
Thank you, Alexander. Our next question comes from Olaf Storbeck from the Financial Times. Olaf, the line is open.
Hello, can you hear me? I'm dialing in from the webcast.
Oh, very good.
Yeah, I also have a follow-up question on Russia. So, I mean, how likely is there any probability that this whole process might be derailed by kind of the regulatory or the lack of regulatory approval, and potentially the fact that you won't get it, as it's kind of now dragging on longer already than you expected? And could you maybe also slightly elaborate a bit on what the actual obstacles are, what the issues are that needs to get resolved? Thanks.
Yeah, okay. I don't think there are any obstacles. Just the process of selling companies can take time. So that's often the case. So, sometimes you can take up to 1 year to sell a company. So in this case, if you remember, basically this is something that is coming from April, May, and this is even a more special situation. So it's not unusual that it can take a long time to get to a transaction. Think about when we did a transaction in Poland, there was February or March, and we ended up closing the transaction in November. You can imagine that was a little bit easier compared to closing down this one. So it's not unexpected that it can take up to 1 year. And to your question whether there is a likelihood, you never know in life, but I would say this is not our working hypothesis that we might have a problem. So there is nothing really unusual. it can take really up to 1 year, still something normal. If you go beyond the year, then I would say this becomes a little bit unusual. But a time of 1 year approval is not unusual at all.
Okay, thanks.
Welcome.
Thank you, Olaf. Our next question comes from Julie Steinberg from the Wall Street Journal. Julie, the line is open.
Hi, thanks for this. I wanted to follow up about PIMCO outflows and see if you can elaborate a little bit more and your outlook as rates continue rising.
Sorry, can you repeat the question? Because there was PIMCO outflows, and then what did you say?
Sure, just yes. If you can elaborate on the PIMCO outflows and then give us your outlook as rates rise.
Okay, so aside from the PIMCO outflows, what we see right now is clearly a reflection of the uncertainty. Think about that. If you are a bond investor or somebody who wants to invest potentially in bonds, then clearly you're going to expect for the right timing, because right now you might say rates are going to go up, so I stay a little bit on the sideline. So from that point of view, it's not unusual. We see the rate volatility is very high right now. We see this in our Solvency II model, that rate volatility was like 50 basis points at the beginning of the year. Now we're speaking of, I believe, something which is much higher, which is closer to 90 basis points, just to give you an idea. So there is a lot of uncertainty right there regarding rates. So once this uncertainty is going to go away, and this is going to go away once there is no more conversation about whether central banks are going to raise rate or not, then at that point in time we're going to see flows coming back. And I believe we are not just going to see flows coming back, we're going to see strong flows coming back. And then you have also to consider that the accretion of the assets under management is much stronger. It's going to be much stronger. So fundamentally, sure, right now we are seeing the downside of these changing rates, but eventually we are going to see the upside. And what is also important to notice, PIMCO had just 600 million of operating profit. They had 1.8 billion of operating profit, so the profitability of the company is very, very strong. We are speaking of 1.8 billion of operating profit for 9 months. And I would say once the stability comes back, we will see a lot of growth coming, starting from a very strong level. About rates expectation, I'm not, nobody can really predict what is going to happen to rates. I believe that central banks have to walk a fine line, because they have already increased rates significantly, and there is a point where additional rate increases can really harm the economy. On the other side, clearly they need to keep inflation under control, but I would say they need to walk a fine line, so future rate increases might be less sustained compared to what we saw so far. So if you ask me, but that's just a personal opinion, I believe that by the Q1, Q2 next year, we're going to have better clarity and more stability coming to the system. But honestly speaking, nobody really knows, so that's just my personal view.
Got it. Thanks very much.
Welcome.
Thank you, Julie. Our next question comes from Stefan Kahl from Bloomberg. Stefan, the line is open.
Yes, hello to everyone. I just have one last remaining question. Can you give us a better sense of, what the net effect is from actually transferring those AGI US assets to Voya? On the one hand, you have this one-time positive effect that you booked last quarter, or for the third quarter, the 500 million. And then you also have restructuring costs. I think those stretch over like a number of quarters. But what is actually the net result of all of this? So what will you gain from actually transferring the assets to Voya?
Okay, no, I understand your question. So yes, the restructuring costs that we encountered so far are a little bit more than 150 million euro. So they need to tax effect that. So I would say that You could take the 300 million gain because the number you quoted, let's take the 500 million because that's fair enough. And then you should run against that number, I would say, after tax, about 150 million of restructuring, because we are still going to see some restructuring moving forward. So that would be a good representation of, if you want, the one-off impacts due to the gain and also the restructuring that we are incurring from for the transfer. That could be a good representation.
So did I get it right? So the net effect would be something like 300 million?
Yes, something like that, yeah.
Yeah, okay. Thank you very much.
Welcome.
Thank you, Stefan. For now, our last question comes from Jean-Philippe Lacour from AFP. Jean-Philippe, the line is open.
Yes, hello. I have 2.5 questions, if I may. So the previous question addressed to PIMCO and the withdrawals related to the interest rates. You would have the same answer for Allianz GI, I presume. Maybe you can just confirm this. Secondly, how do you explain that the Hurricane Ian had such a light impact on your accounts when we speak of insured loss of about up to $40 billion alone for Florida, according to Fitch? And this third question may be beyond this call, but we have recently seen acts of light vandalism on works of art by climate activists. I'm wondering if that generates new reflections on the level of insurance of this kind of works. You're already insuring, but okay, you have an offer, but you have seen maybe new customers contacting you about insuring this kind of works of art or any other works you could be a target of these activists. Thank you for these answers.
No, thank you for your question. The last one, I'm not aware of anything, so we might double check, but I'm not aware, so at least it didn't raise to my attention. On the Hurricane Ian, the point is our business profile is not so maybe pronounced in over there in Florida, but also we have a reinsurance program. A lot of our business there is specifically reinsured, so this explains why the loss is for us less compared to others, business profile, but also a lot of the exposure there is reinsured. And then on the question regarding PIMCO and the GI, yes, what I said for PIMCO is also true for the GI, but we need to keep in mind the GI is a little bit of a different business profile. So PIMCO is definitely a little bit more exposed to the positive and negative of rate swings. This applies anyway clearly also to AGI, but to a little bit less degree. But in general, if we speak about asset management, and I'm not just speaking for Allianz, I can speak also for the sector. Clearly, in a situation like 2022, you are going to see flows going down, but eventually, investors will come back. So that's fundamentally a truth which is relevant for all kinds of asset managers.
Thank you.
Welcome.
Thank you, Jean-Philippe. There are right now no further questions in the line, so last possibility. Press talk request if you want to place another question, or *5 on your telephone. So there are no more questions. Then with that, I would close the audio web conference today. Thank you for your participation and attention, and goodbye.
Thank you, guys. Have a good rest of the day.